Okay, good afternoon or good morning, wherever your time zone is. This is the option professor speaking. And today I am going to be going over a few different areas, considering the options area and currencies, as well as crypto. And then, of course, we're going to go over things like the grains and the gold and the oil, and give you a little idea of what our opinion and our view is. Okay, so again, the option professor is a situation where we will give you our views and our opinions, but we are not giving you advice. Obviously, you get that from your brokerage firm, but are going to share with you our views. Quick background, we've been in this business for over 30 years, and we have done hundreds and hundreds of seminars for thousands and thousands of investors worldwide, educating them on the uses and the risks of options and investments in general. And we, again, do have question and answer periods we have with people so they can ask us questions on different things, and we try to help them with some informed answers. So today, that's what we're going to go over. And again, I'm a graduate of Boston College, and again, I've been in the business of investing for many decades. So obviously, I have a certain amount of product knowledge and experience, which I'm going to share with you today. Okay, with regards to the markets, okay, let's take a look at, now we're going to look at the graphs here, okay? And what I like to do is to look at different time frames, so I get an idea of what the markets are doing. And so basically, you're looking at a situation where a longer term graph, using a 12 SMA, 24 SMA, and a 36 SMA is going to be a lot less sensitive to each movement and give you a smoother line for the trend than a 5-year, 1 year, and a 1 month. You're shrinking your time zones to try to get the short-term look, in a middle look, intermediate look, and the long-term look. Okay, so that's how we're going to view these markets, and then I'll give you different viewpoints on the options, the currency, and the different oil, gold, etc. All right, so let's start out with the S&Ps, because that's what everybody kind of follows. As you can see, the S&P was in a very nice uptrend from 2010 all the way up here, and is still in an uptrend because the blue line is continuing to rise, but it's under pressure right now. Now we're up about, this is an area where we could bounce out of, but you can see that it tests the long-term average here in, that's 2011. It tested it and broke in 2016, but it didn't last very long under the blue line and got back above it. So that's why this is very important. Right here, we broke it again in 2018 when the Fed was hiking, okay? But it got right back above it. Then we had the big crash because of COVID, and that was a real big break. But within a month, it's right back above it. Right now, it is breaking underneath the line. Right now, it comes in at 37.11. So the sooner it gets above 37.11, if you're bullish and you'd like to see the market not go down, that is what you need to see. You need to see it hold this area here. You can see this former high right here is at around 35.88. So we came down close to it when we hit the low last week. And that low was, where was the low? The low was 36.36. So maybe it goes down towards this high point here, which is 35.88, or the next one down would be 3,400. These two high points could very well act as support. The final high points that could act as support are just under 3,000. You know, if you want to know where you get these kind of numbers from, you take the earnings on the S&P, which is supposed to be about $2.30, and you multiply by 16 times PE ratio, and you get 36.80, and that's why we are where we are, 16 times the current earnings. Now, if we go down to 14 times the current earnings, that's where you get a number like 3,200 area, okay? So the bottom line is if we are going to go and tighten those PE ratios down to 14, that's where you're going to go. If it's going to stop around here, then we could have some kind of a rally out of here. The other thing you have to worry about is, are they going to cut earnings? Because right now it's looking at 230, and next year I think they're still thinking the earnings will grow again. So if they cut the earnings by 5 or 10 or 15%, that's going to have an effect on this. The other thing is the reason the PE ratios are contracting is because interest rates have gone up. when you have zero interest in money market and you've got the long bond at 1% or 2%, obviously you can value these stocks at a much higher multiple. When the rates go up to 3, 3.5, if they're going to 4, 4.5, those multiples will tighten. And that's why we've gone from 21, 22 PE on the S&P down to 16. But the pendulum swings, and we swung way the one way up to 22, and the middle area tends to be about 16. And since it generally doesn't stop at the middle, that's why the door is open for a PE ratio of 14. So don't run around town wondering why the stock market's dropping while your companies are making money. Just realize that it's a mathematical formula called the price to earnings ratio. And it is coming back to normal, just like interest rates are coming back to normal. So again, that's what you're fighting here now. You're fighting what we talked about. Listen, we have a weekly letter we send out. We've been telling you this about 2 years. These PE ratios will not last, okay? And they have not. And so the bottom line is that this is called reversion to the mean. That's what we were talking about at 4,800. We're going to revert back to the mean. That's what the mean is, okay? And sometimes we overshoot, which is what we very well might do here as well. We'll have to see one day at a time. Okay, so basically that's the story on the S&P. Now, if we look at shorter term graphs, oh, by the way, one last thing. Another bad thing right now is that the RSI has broken underneath 50 and it's trading at around 43. Okay, that's where the US, and when you're under 50, you tend to be in a more of a down market. So it better stop here on the RSI. We don't want to see it under 40. Because look in 2008 when it got under 40. Here it is at 40. And then if it breaks under 40, you can go 50% drop in the market. You know, things can get very hairy. So under 40 on the RSI is not what you want to see. Can you see here? It stopped right at, well, here it's, let's see here. 41. So, you know, in 2020, it stopped at 41. Right now we're at 43. So we want it to stop here if you're bullish, and we want to get this baby back above 37.11. Those are two very good things. You start breaking under 3,600, this RSI breaks under 40, and then it's bar the door Katie as far as I can see. That's just our view. That's our opinion. Okay. So on the 5-year graph, what are you seeing? On the 5-year graph, it's looking like it wants to go into the abyss, and you can see the RSI again is way down to 30. See, again, once it broke under 40 on RSI, which is right around here, it starts accelerating to the downside. That's not good. Okay, and then on a 1-year graph, again, everything pointing down. The only good news is you have a little bit of a divergence. The low on RSI right here was 41, and the low on RSI here, hold it now. The low on RSI, well, you don't have much of a divergence at all, so forget that one. What you do have, though, is the red line is up here at 39.70. So if it does start to move up, you could have a gap filled here and maybe even a gap filled here at 4,000 on a bear market rally. So it's possible to have a bounce. If that's the way you like to go, then you can do it. Now, before we'd even entertain the idea of a bounce, we'd like to see the red line on this one, which is the monthly, start turning up. So let's get this baby to go above 36.90 and get this average turning up, because when it does, you can get a rally. You see, it went up here. And we went from 39.40 all the way up to 41.60. So you got a nice 200-point run. So again, if this thing can turn up, and if you can get this RSI above 50, and it's right now at 35, so if you can get it above 3,700 and the RSI above 50, it could open the door to a move of 3,900 or even as much as 4,000, 4,100 if things really turned. That's not the direction it's pointing, but you know, that's what you look for if you wanted to get bullish. You don't want to, you know, in our view, you just don't want to stand in front of a freight train and say stop. That can be a rough racket. So there's not many indicators right now that are saying we're going back up. I know the S&P has on Monday has turned up 40 points, so it could be the start of something. We'll have to see. So that gives you a little idea of what's going on with the stock market. QQQ, I'm going to give you. And then I'm going to go into some option strategies for you. But first, you got to know, before you look at options, you got to figure out where is the train going, because that is going to determine what strategies you're going to entertain, right? So let's take a look at the QQQs, which is your NASDAQ, which is your tech. And as you can see, tech did bust underneath the number, okay? It went down here to a low last week of, on the QQQs, went to a low of 269. The blue line here comes in at 290. So getting back above 290 would be helpful. And your RSI, again, just like on the stock market, it's hanging right at 40. You don't want this thing to go way under 40, that's for sure. So you're right on the ledge on both S&P and QQQ. Could be a very good area to take a shot from the buy side, because this could be the low area. Not a lot of evidence of that, but it would not be a shocker to get a bounce out of here, simply because that RSI is at that very important 40 number. And we did break the blue line, but the blue line is rising, which means the trend on a long-term basis is still up. But that's the first time we really broke. Even during the crash of 2020, it hardly broke underneath there by how many points? The low was 164. And it broke underneath the blue line at that point, which was 172. So you got less than 10 points underneath before it got above it. Right now, it's already gone 20 points underneath. So it's a different ball game. And why is it a different ball game? Because interest rates are much higher. Ergo, valuations have to change, and ergo, we could see some cuts in some of the earnings if the economy is going to slow down. Okay, and retail sales last week gave us an idea that the economy may be slowing down because the consumer did not spend as much as people thought. Okay, so let me explain a couple of option strategies to you generically, meaning these are examples only, hypothetical examples only. These are not actual trades, so obviously they're different, but I'm going to give you the concept of what you'd want to look at. Okay, one strategy, when you're up here at the 400 mark on the Qs, okay, and you can see you're that far away from the moving average. I mean, when we were up here at the top, can you see the moving average was at 258 on the blue, the 36 SMA? Okay, let me tell you what that means. That means at the high point, we were at where are we here? Yeah, at here we're at 408. And the 36 SMA, when we were at 408, was at 258, which means we were 150 points above the 36 SMA. Divided into 258, we were 58% above the moving average. Now, if it gets 25, 30, it's considered overbought. 58 is an absolute joke. So again, this is an area where you know that you've made a lot of money, you're happy, the whole world seems round, but then in November of this year, the Fed tells you they're going to pivot. And you see in November of that year, we hit the high. When they say they're going to pivot to tighter money, that might be a time for you to say, let's sell the 420 calls and buy the 380 puts with the premium. So now you have upside potential to 420, and you've got a floor on your equity at 380. And let's go a year out and let's sit on this hedge and see what happens. And what happens is the market goes down to 280. And so you've protected 100 points of your gain. And you would have given up only 20 points. You would have been able to make 20 till 420 before they would have called you away. And of course, you could roll that up by buying back the 420 and going higher. But this is a collar strategy, and that's something to do at a higher point when you're trying to protect your equity. It can be done at any point. Generally, you like to go 20% above the strike and sell the call. And then if you want to use that premium as a put underneath, that's a way to put parameters around your equity. Okay. Now, there's a lot of different factors that go in whether you do it or not, but that's the basic concept. Take in the call premium and use it as insurance underneath the price. The other thing you could think about when you're at a high point is you sell out of your position and replace it with calls. Okay. And so there you're going to take your gain, which might have been from 180 to 400, 220 points, and replace it with a call option for 10 bucks. If you take out 220 and you put back in 10 on a call, and then the market goes down, you lose 10 on the call, but you keep the money that you took off the table. So there's a couple of strategies right there on the options that would be of interest. The other strategy now, if you really believe we're at a low point, and you have, now this is an index. So let's take a look at a company that you might believe in as a company that has a, hang on a second here. Let's take a look at something like Microsoft. Hold on here. MSFT, Microsoft. Okay. All right. So now this is a strategy someone might consider if they wanted to own the stock, but didn't want to buy it at the current value. So this is, you can see the blue line there. So you might say, you know what? We're at 240. I'm willing to buy it for 220. So if you sold a put option and you had the cash in your account to buy the stock, if it is put to you, you could sell that option at 220, and you're contracting and obligated to buy 100 shares on each contract at 220. So you're, say just using a theoretical example, let's say the premium was 10 bucks. If you sell a 220 put for 10 bucks, you have got a situation where you're agreeing to buy the stock for 220 minus the 10 bucks, or actually you're agreeing to buy it net of 210. Okay. Anything under 210 will cost you money because the 210 is going to be your cost basis in this example. Now, if the stock never goes to 220, the option will go to zero and you'll keep the premium when it expires above 220. Okay. If you want to be protected against an up move, you would sell the put at 220. And let's, as an example, theoretical, hypothetical, you get $10 and you take the $10 and you buy the 260 calls. If the market goes up to 280, 300, you have the right, but not the obligation to buy at 260. You're obligated to buy it at 220 when you sell the put. You have the right, but not the obligation to buy it at 260 when you put the call in there. So you're taking the put premium and you're buying the call. Now, if it goes up, you've got a 260 call that will benefit. And if it works out where the math is, whatever you got for the put, you paid for the call, then your cost basis, as far as that is concerned, has been reduced because of the 220 put, you receive the premium. And there you can participate in the upside. Okay. The risk on there is you got to have the money to buy Microsoft at the 220 strike. You've got to be willing to take the risk of buying the stock at 220 strike. But when the markets are down and the premiums are big on the puts, this is when you investigate that tactic. Again, I've been doing this for decades. So would it be worthwhile to have a conversation with me on it and find out the uses and risks of the options? And again, how these tactics would work? It might be helpful. And that's why we have a question and answer one-on-one, where we can speak to you and go over some numbers with you so you have a better understanding of this. Because obviously in this short format, we can't go into all the features and the uses and the risk of the tactics. I'm giving you a very broad stroke. Okay, but those are three things right now based on where the market has been and where it is now that people might consider in the options area. Some people also like a strategy where you buy an in-the-money call. They don't want to pay $247 times 100. And what's that? That's going to be, if you bought 100 shares of this thing now, it's going to be $24,700 based on current price. They may want to buy a 220 call or a 230 call or a 240 call that's in the money and maybe go a year out. And then they may want to use the shorter term calls out of the money and sell those against it in order to try to bring their costs down on the call they bought. And ergo, try to get to a situation where if you sell enough premiums against the long call, you might even get all the premium you paid on the call over time. Again, the risk is it goes into the tank, and whatever your risk is on those calls, you would lose that. And then the other risk is opportunity risk. If it goes through the roof, if you sold a call, that is going to cap your upside to whatever the strike price is on the call that you sold. So again, few different things to do here. I do get questions on all these short-term options that are suggested on TV. And I have to remind people that you must know that the time premium and volatility premium of an option has got to come out of the option by the time it expires. So you might notice that when an option goes in the money, it loses its time and volatility premium, and they only give you the intrinsic. So on these short-term options that are out of the money, you have to understand if you hold it to the strike, to the expiration, and if you're holding an option for a week or two, that might be likely. You're going to have to see it go to your, on a call option, you'd have to see it go to your call strike plus the premium just to break even. On the put side, your strike price minus the premium is your break even when you're looking at these short-term options. So caveat emptor, and if you haven't taken Latin, it means buyer beware. Okay, so there you go. There's a few different option strategies for you to check out and do more homework on. Again, we encourage people to just contact us directly because, you know, are you going to find a lot of people with more experience and knowledge in this area? In our opinion, we're right up there. So bottom line, take advantage of that opportunity. And at the end of the broadcast, we'll explain how you can do that. All right. So basically that gives you a little bit of an idea of some of the different option tactics. Obviously there's a lot more, and there's a lot more to know. You know, obviously, we've traded thousands and thousands and thousands of options over the decades. So we're pretty familiar with the product, and we're pretty familiar with the uses and risks. So we're not the worst guys, I don't think, to hear what the whole story is. You know, we're not so anyway, just remember that. Let's turn towards the currency area, which is the other area that people wanted to take a look at today. And let's start out with the dollar index, because again, we have a weekly market update that we send out, and we have been very much of the mind that the bond market peaked in 2020. And we've been telling you that for 3 years now. Why? Because when you go and get $16 trillion globally of negative yielding bonds, what that means is you loan the money to these countries and they don't even give you your money back. You actually lose money by loaning them money. Does that sound silly and stupid and ridiculous and something that probably happens once in history? Well, I think we feel that way. So again, that situation, is gone, and it never should have been here, right? Negative yielding bonds. I loan you money, you don't pay interest, and when you pay it back, it's less than what I gave you. I mean, who's going to go for that deal? That's one of the risks in the bond market now, because there's a lot of money running around like that, and there's a lot of money at lower yielding bonds, and people in the bond market have gotten whacked very, very hard. And if they all decide they want to come out, or, obviously if volume picks up to where they all want to come out, and the Fed is now tightening, that is called the perfect storm, like the movie. And that didn't end so well for the crew. So the bottom line is that be careful, because we could have some events possibility ahead of us. Because of why? Because the amount of debt that was created under 3% is ridiculously large. And we are above 3% comfortably on the 10-year note and the 30-year, and even on the 2-year. So if it goes to 4 or 5 for whatever reason, do those people who own those bonds that are getting killed, are they going to be, is there a pressure point where they say, get me out? And there could be. So that's where the risk is on the bond market right now, is the amount of debt out there that's under the current yield, and they're losing money, and their income is low on it because you only get the coupon. Then some of these things have 10 years, 30 years to go. You could get a little bit of a rush to get out. So again, the US dollar has been benefiting from what? They've been benefiting from higher yields, but now the whole globe is starting to bring their yields up. So again, as our yields go up and theirs go up, maybe it's going to put a little bit of a calming effect on this dollar rise. Because look at the dollar rise. This thing went bullish here at 91, and this darn thing went up to 106 almost. Now that's higher than it was in 2020 when we had the panic. And let's go back 20 years and you can put it in perspective. It's the highest time we've been since 2020. I mean, excuse me, 2002. So we're talking 20-year highs on the dollar. Okay. And we're looking, is it very far away from the moving averages? Well, where's the blue line here? Let's do it so you get an idea here. I'm trying to quantify for you. We hit a high of about 10. Well, we don't have to guess. What's the high? The high in June here is 105.56, and the moving average is at 95.71. So how far are we above the moving average? We're about 10%. So again, you can see here in 2015, it got even further away. Okay. And here during the crash, it got pretty far away. So we're pretty far away because this is probably not, the currency is supposed to be a little bit stable, right? It's not supposed to be all over the place. So the bottom line is that if it cannot take out this 106 number in the next couple of months, then we could get a situation where it could revert back to the mean. Can you see here in 2016 and 17? Okay, it made a high point one month here at 103 and change. The next month it made a tiny bit of a new high at 103.80, and then it was right down. But again, it did flatten out before it did that, and the red line has not even flattened out. So it's very premature to talk about the dollar pulling back too much, because again, the red line will be the first inclination that it's rolling over. And if you really want to get a big drop, you have to have the red line pointing down, in my view, in our view. Okay. All right. So there's your dollar on a 20-year. On a 5-year, you can see that too. And there's a bit of a divergence here if this thing holds up. So if you don't see 105.56 getting taken out and it starts to roll over, again, there is a divergence here on the RSI where it was 81 on that first high, and the second high, it's only at 69. That's a divergence, and that indicates that that could be exhaustion. Only time will tell. Keep an eye on it, though. This is a neighborhood. If that high is not taken out in the next while here, again, you do generally get the red line pointing down before you get a big drop. So don't get too excited because that red line is still pointing straight up. But it's something we'd be monitoring. And when that red line turns over in our weekly updates, we'll be suggesting people to start getting on the other side of the dollar. Okay, there you go. So that's pretty much it. And everything else just falls into place. So we'll look at the yen, which is at like 25-year lows, and give you a little bit of an idea, what we think here. Again, it's like the dollar. Is it low? The dollar's very high, right? But has it turned down? No. Is the red line turned down? No. So the bottom line is on a 20-year graph, it puts it in perspective how oversold it is. Look at it, it's down at 74, and the blue line's up at what? 91, 90. Now let's do 16 points. 16 divided by 74, you're 21% under the average. That's oversold. Now, again, this thing can keep going like it did here. Who knows where it's going? Again, but there is some rumblings that Japan's economy is going to pick up because of their low currency. And if China, doesn't invade Taiwan and things go okay, maybe this thing could have a bounce. But, there's nothing here to put your hat on. Even the 1-month graph, which would be the first one to turn up. Yeah, even that, if you're a short-term gambler, you'd need it to get above 74.54, and you need that RSI to get back above 50 if you're even going to get anything out of it. So, keep an eye on it, but it looks premature on all this stuff because, again, you try to be the first guy at the party and, you could look like an idiot hanging in there with nobody in there for 2 hours, right? So the bottom line is wait till you have some company on this thing. Wait till some of these averages turn up, although it is tempting, obviously, because it's so cheap. Euro currency. There you go. Okay, a little better look. It gave you a little buy signal on the euro at 105. Okay, and the blue lines are pointing up. This is on the monthly. Okay, this is the shortest term one we would look at. And then if you look at the longer term stuff, let's see if there's anything there. Yeah, you see, it's got problems right here. So you could get a little bit of a rally, but the RSI is still under 50. But until we started getting that red line pointing up, which means you're going to start having to see a 107 print on this thing, and it's going to have to stay above 107 to really give you an idea that it's going to blow out the 108 area and really make a northern move. So keep an eye on it. You start seeing 107 or better, it can hold up there for a while. These lines will turn up. The RSI gets above 50, and you might have something going on. So keep an eye on the euro. Again, they are starting to hint at making a hike in their rates finally. So there could be something there, but it needs a little bit more price evidence. Turning towards the 5-year, again, still pointing straight down, but the number comes in at what? 106.30, 106. So again, you get above 107, it could start the process of turning the red line up, which would be nice. And then basically on the 20-year, again, it could have a bear market rally all the way back up towards 112 and still be in a negative move. So that's why you could get a bounce up here. But again, that thing's pointing straight down. So if it gets underneath these lows of 104, 103, again, it could go into the abyss. So this is a tough time to be trading the currencies because they're all extended, which makes them seductive, but they also have very, very consistent trends that don't look very good. Turning towards the Aussie dollar, some people were telling me that Aussie dollars was going to go to 78. Let's see if there's any. Let's see if there is any hope to that one. Australian dollar. Okay, here we go right here. I guess this is the one. Okay, so they were saying we're going to go up to 78 on this thing. And as soon as they said that, it went to 69. So on a 20-year graph, again, you'd like to see, and it's very much at a very good juncture here. You don't want that RSI under 40. So again, if you can get this thing above 70, 71, 73 and get it back going again, but again, RSI looks like it's almost ready to give it up. So this thing stays under 71, and the longer it does that, these averages are going to start pointing down and down and down. So again, get this baby back above 71, 72, 73, and you might have something cooking. Keep an eye on it. Too early to tell. Right now, it doesn't look very good. It's underneath all the averages, and the RSI is pointing down. Turning towards the 1 month, is there anything happening there? This is a short term. Well, again, here's something a little bit constructive, but the RSI looks terrible. Again, getting above, if you're a short-term trader, that red line is pointing up. That's a good thing, but you're going to have to stay above 69.60. Let's call it 70. Get this thing above 60. Well, get it above 69.80, 70. You see, because you could have a formation where the low here, the move up to 70, now a pullback. So maybe it will go after that 70 number. And if it does that and takes it out, you could get more real estate on the upside. So short-term traders, get it above 69.60, 69.80, and then it takes out 70, you could have something cooking. But again, that RSI, you want that thing pointing up, and it's not doing that right now. So again, the dollar may be hitting a high point, too early to tell. These currencies may be hitting a low point, too early to tell. That's my analysis of the currencies as I can see them. And let's see. All right, let's just look at one last one, British pound. Because they do have a situation where they are separate from the euro. And if you've been to England, and the UK, they certainly seem to have a lot more money than a lot of those other countries in the euro. So that might make it more attractive. All right, on the 1 month, very similar to the euro. It seemed like you got the buy signal. Well, you got the buy signal on the red line down here at 120. So you made a nice little move to 124. Now you've got the red line and blue line and everything converging right here. So this is definitely crunch time, and the RSI is at 50. So you want to talk about crunch time this week, next week will be crunch time for the euro. If it can get above the 123 number, I think then you might have something cooking because the RSI would start pointing back up. Okay, on the 1 year. again, looks lousy. So even if it got up, look at all that resistance it's going to run right into. Again, this is a pretty big divergence, though, because this RSI is much higher than it was down here. So that's a good sign that this could be this was an exhaustion low. And so far, it does look like it. But again, the downtrend is controlling it. And that's a problem when you want to get bullish during downtrends. You run into a wall sometimes. 5-year graph, again, it's oversold. So of course it could rally, okay? But again, playing it for bounces, unless you keep it on a very, very short leash, which is what we obviously would suggest, you got to be careful because you are playing with fire down here. But again, there is some reason, you see that low, the RSI is not as low. So there is some reason to think that there could be a bit of a turn going on. So keep an eye on it, but it does look like it needs a little more price evidence to be good. All right, let's before we run out of time, let's go over some of the different markets like on oil. The whole world is telling you to get into oil. We talked about oil back in 2020 when it went to minus 37. We talked about Occidental Petroleum when they were paying 35% on their 10-year non-callable bonds, 35% yield back in 2020. That's when we liked it. 2021, that's when we liked it. Early 2022, that's when we like it. Now we're going to show you why the bloom has come off the rose, and you got to be more careful because we're over $100 on crude, but we haven't been able to take out 130. And some of the stocks I'm going to show you now, have rolled over. The ones they're advertising to buy, these newsletter guys and all these people telling you to buy. Let's take a look at it. I'm going to start out with the price of crude first. Okay. Crude oil, West Texas Intermediate. Okay. Again, as we say all the time, when you get this far away from the moving averages, it's not the time to start putting your initial position on. This is a 20-year graph. You notice we haven't taken out the 2008 high. Will it? Only, I think, if there's going to be some kind of an event, that's going to make things even tighter. It could happen, but this is a more dangerous place to buy because it's so far away from the averages. When we hit this 130 mark, the average was down at 58. Now, let me help you with the math. 130 minus 58 divided by 58, you were over double the moving average. You don't have to be from Harvard to figure out that's overbought. Now, of course, there's a special situation, but I'm sure there was one in 08 too, and then look what happened. So again, we would be somewhat more careful up here, and we would probably have some defensive strategies going on, like covered call. Like if you're going to buy something up here, maybe covered call writing is not a terrible idea, where at least you get some kind of downside hedge against the stocks. Okay, let's take a look at some of them. This is one of the best ones that everybody always talks about, Devon Energy. Well, if you bought it lately, it's not been that great. So again, look at it. It's at 80. The moving average is at what? 24. I mean, come on. This is not a rough time to start your position. You've already lost $22 and it's only been a couple of weeks, right? So the bottom line is if you are going to do something up here, it would make some sense to sell a call when you buy it and then take the call premium and buy a put and at least put some parameters around your equity. Because if it's going to come down and test the red or the blue lines here, you're going to get whacked pretty hard by fooling around with it up at this level. Last time it was at this level was 2014. It has been higher in 2011. And of course, in 2008, it went all the way up to here 130. So, I mean, this thing, listen, anything could happen, but the RSI is not pointing up right now, is it? Right. And you are already down 22 points off the high. The trends are still up. There's no doubt about that. And again, when you do get the big collapse, the red line is generally pointing down, and that's not happening. So I'm not trying to, put a lot of water on the thing, but, I'm trying to explain something. If you get this far away from the averages, some type of hedging would make some sense, unless you don't care about losing money if it goes all the way back down, and then that's a strategy too. The 5-year graph, again, look, it's way up here at 80. Look where the averages are. It's like a magnet. It's coming back to the mean. So this is a neighborhood, right? Between what, 54 and 50 and 60, that it is having some support. And the RSI is right at 50. So you don't want this baby going under 50. So this is a neighborhood where it could be a situation where if you really love this company and you have money on the sideline to buy it, you could sell a put at 50 and then use the premium to buy calls above. And then at least your risk is now at 50 rather than 58. And then basically you're hedged on a big up move because you bought the calls at 65. How far out you go and other factors, those are to be determined. But the broad stroke general idea is you've got money on the sideline and you're willing to pay 50, and you take a premium in for that, and then you take the premium and you hedge yourself against an up move by buying the calls. Okay, so that's something. But again, if this energy market is about ready to roll over and go back under 100, and this stuff breaks underneath this blue line, well, let's put it this way. Right now, if it stays under the red line, which is 66, every day it's under 66, that red line will start turning down. And the red line turning down is not a good thing. So if you want a real big number to watch, I would watch the number 66.23. When it's above there, then you'd feel a little bit better about where you're at. Turning towards the 1 year. There you go. You see, you got the sell signal on the 1 year here at 75. When the red line rolls over, it's time to go. And now it's way oversold here from the red line. So again, you could get a bounce out of here because it has not taken out that low yet, which is at 53. And again, it didn't take out that low, and it didn't take out that low. So again, if it doesn't take out that low and gets going, you might have something. 1 month graph, I'm sure, looks lousy. So again, you're in the abyss here. Basically, it went to 80, and anything 75, 78 was get out of town or hedge it. This is where you sell the out of the money call, buy a put. This is where you get rid of the stock and you replace it with calls. That's what you do if you want to protect your money, or you can go into the water and get wet. Okay, so there's your energy market, and I'm sure there's other stocks. I'm not going to go through all of them because I want to get through the gold market and crypto and the grain. Let's take a look at soybeans. Again, the idea is that we are looking for the general commodity sector to peak this year. Okay, and so far a lot of these things have peaked, and you'll notice as I get into the stocks on some of these things, the stocks look like they may have peaked. So here's your July soybeans. And basically you can see that they peaked up here at about 18 bucks. And they're very far away from the averages. So you get the idea why we think they might have peaked? Okay, I've got to go pretty fast here now. So let me go fast. This is CF Industries. Again, these are one of the companies that are involved in fertilizer and things like that. Does that look like it might have peaked? Okay, now we're going to go to ADM and Archer Daniels Midland, and you get an idea of what I'm talking about here. That looked like it might have peaked. Okay, now let's go to gold. Newmont Mining. That looked like it might have peaked. Okay, now let's go over to copper. Freeport McMoran. That looked like it might have peaked. Okay, and that just gives you a little bit of an idea. Okay. So that gave you, a little bit of an idea on the options, a little bit on the currency, and a little bit on some of the commodities. Okay. Now, what I did want to do now as we wrap up is to just reintroduce ourselves, the Option Professor, and our email is, our website is optionprofessor, OPTIONPROFESSOR.com. You go there and you can get a PDF report. We'll explain how you can get it. And the PDF report is how to hedge against market declines and upside surprises. We've been telling people to get this thing for 2 years. Why anybody has waited is beyond our imagination. So go to optionprofessor.com and get the PDF report on hedging downside risk and upside surprises. Also, we are available to speak to you and go through some of this information one-on-one, which we obviously think is very helpful. So that's the two things. If you want to email us, it's optionprofessor@gmail.com. Okay. So again, go to the website. We obviously have a lot of experience. We obviously have a lot of knowledge to share with you. And we didn't sell you a newsletter for $10,000. And we didn't tell you to buy a bunch of stocks that went way down. So we're different. We're independent from the other stuff that you've been looking at. We're not telling everybody just to hold on into the abyss. We obviously are trying to help people work with the risk in the market and increase their awareness on alternatives. And then you guys take it from there. So again, optionprofessor.com, get the PDF report on hedging, optionprofessor@gmail.com. Give us your questions, comments, or anything else. We're here to help. Thank you very much for being with us today. I'm going to sign off now. Again, this is the Option Professor, and we definitely look forward to speaking to you and seeing how we could help you as well. Have a great day, everybody.